Hi, this is Lucinda Bachman with Supreme Lending, and I'm here with my good friend Teresa Carpenter of Eanes Properties here in Austin. And we're here at Mandola's this morning, and we're going to chat about frequent questions that home buyers have for both of us during the process, before, during, and after. So join us as we continue to talk about the process.
Well, Lucinda, I was so green when I bought my first house. I didn't know anything about lending, mortgages, loans, nothing. So as a realtor, I want to help my first-time home buyers and sometimes my seasoned home buyers who have questions. So I've got a list here I've prepared. So you ready? I'm just going to
Awesome.
rapid fire.
Okay, let's go.
All right, first of all, what are the first steps in the process of buying a house?
First step would be an application. This allows me to pull your credit, and it will give me the areas to go into to see which kind of programs you qualify for, what kind of numbers, what kind of sales price, down payment programs. So the first thing to do is the application. It doesn't take long, maybe 5 to 10 minutes at the most. Push a button, submit, I get an email, and there I go.
Well, tell me about the different kinds of loans, the fixed, the variable.
There are numerous programs. There's FHA, conventional, I have VA and USDA. I have fixed rate, I have ARMS, which is an adjustable rate mortgage. And these are mortgages where they're fixed for a certain time and then they change after a certain time. And then they will change annually thereafter until you fix it into a 15 or a 30-year fixed. So it just depends on what you want, what your goals are, how long you think you're going to be in the house, and what your credit looks like, what kind of down payment. There's a whole lot of moving parts when it comes to which program to go on.
So when I get ready to apply for a loan, what kind of documentation do I need to have prepared for you?
The basic documentation that we will need is 30 days of pay stubs, your last 2 years of complete tax returns, all pages, all schedules, with all W-2s, 1099s, etc., and 2 months of your most recent bank statements, meaning your checking account, your savings account, 401ks, IRAs, wherever you have monies deposited. Even though you won't use that necessarily for your down payment closing costs, the more money we show, the stronger the file. And then obviously identification, your social security card and your driver's license.
And my firstborn male child?
Yes, please.
That seems like a lot, but it's
Yes.
good to be prepared.
Yes.
So how do I know exactly how much I'm going to owe at the time of closing? Like a good idea of how much I need to bring, how much money I need to have. Do you have some kind of calculator or sheet for me to kind of estimate that?
Yes. Once you've done your application, I've pulled your credit and we look and see what you're going to qualify for. So let's just say we've got you qualified for a $300,000 house with 10% down. So that really means $30,000 out of your pocket for down payment. I'm going to give you what's called an initial fee worksheet. And what that is, it's going to give you a turnkey amount with your down payment, all of your closing costs. That includes my costs as Supreme Lending plus your title company fees. And then it'll give also the escrow account, which will be a complete turnkey at closing of what you would need to wire to the title company.
Okay, another thing that people are confused about is PMI. Explain what PMI is.
PMI is private mortgage insurance. This is what goes on to the loan if you do not put at least 20% down. And what that is, it's the investor's insurance policy in case you default on the loan, in case you can't or don't make the payments. Then this is the insurance policy that goes into the foreclosure proceedings.
Okay, so if I'm approved for a certain loan amount, can I really afford a mortgage at that price? So many people are worried that you're qualifying them for more than they can really afford.
Very good question, because a lot of people come to me and they want, how much can I afford? Well, I can get you qualified with that application and that credit report. I can get you qualified for, let's just say, $350,000, but you're only comfortable with a $2,000 payment. So there's a big difference there, because typically a $350,000 house, unless you put 20% down or more, is going to have more than a $2,000 payment. So a lot of times I'll get you qualified for $350,000, Then I show you that estimated payment. Oh my gosh, I can't do that. Well, what are you comfortable with? What's the payment that you're comfortable with? Then I'll back into it that way and let you know, okay, if you're comfortable with $2,000, that means you're probably going to be looking at about $250 on a sales price, depending upon what the moving parts are. So,
And when you look at my financial picture to see what I qualify for, you're looking at like my car loan or all of the loans I have, my coffee fix,
no,
anything
coffee
I
fix
tell
isn't
you.
in there.
No coffee fix. But you're looking at my major debt, so you
Yes.
can figure out, okay.
Revolving and installment is what I look at. So revolving is your credit cards, your Discover, your American Express, your Citibank, that kind of stuff. And I look at the minimum payment. If you have a minimum payment of $25, but you pay $100 a month, I'm only going to use the $25 in your debt to income ratio.
Okay.
It includes student loans and car notes. Anything fixed and revolving.
Okay, so when you're looking at the payment, is it better to roll things like property taxes and mortgage insurance into my monthly payment, or is it better to pay that separately?
It's completely up to you. On a government loan, FHA, VA, and USDA loan, there's not an option. You have to have an escrow account to where your total payment has your taxes and insurance included. If you do a conventional loan and you put 20% down, you have the option to pay on your own or within the payment, but only at a 20% down payment minimum.
Okay, going back to the PMI, the prime mortgage insurance, something that people don't know is when you get an FHA loan now, you pay the PMI, which can be, $100, $200 a month,
Easily.
through the entire life of the loan, not
Correct.
until you get 20% equity.
Correct.
So what are the reasons that I would get an FHA loan? Is it less down payment or?
Well, conventional has a 3% down payment. FHA's minimum is 3.5%. Conventional's mortgage insurance based on your 3% is going to be a lot less in a monthly basis.
Okay.
The interest rate is going to be typically a little higher than a government loan interest rate. But
Okay.
the good thing about the conventional loan is once you get to that 78, 79% loan to value with your investor, your servicing lender, it will be eliminated. On the FHA loan, it is there for the life of the loan, whether it's $100 or $250 a month. It's there, no matter what.
Okay, so when I want to start, I need to have some money saved up, I need to have good credit. What kind of credit score are you looking at as a good starting point to request a loan?
To me, a good starting point would be a minimum of 680. We do have programs that will go lower. We've got an FHA program that will go all the way down to a 580. Typically, if I have pull a credit report and I've got a 600, that's going to lead me into an FHA program because I know that I can get that done.
Okay.
Conventional, you're going to be looking at a minimum of 620, and your mortgage insurance will be reflected of that 620 versus
Okay.
somebody that has a 720. So there's
That
a
makes
lot of
sense.
moving parts.
Yeah, that makes sense, but, so when anybody makes a hard inquiry into your credit, that kind of can ding your credit and lower it a little bit. So, how long does it take hard inquiries to be removed from your credit history?
They will not, from my understanding, I'm not the credit expert, but from my understanding, they're on the credit report for at least 6 to 12 months.
Okay.
At least. But it's what has been pulled within the last 6 months that's going to have the more derogatory effect on your scores.
Okay. Now, as a realtor, I want my clients, my buyer clients, to walk in with a pre-qualification letter. And people get confused on what's a pre-qualification letter and what's a pre-approval letter. Now, which is which, and which is most important, and when do you give them?
I give my buyers that have come to me and they've obviously done the application, I pulled the credit, and they've given me the supporting documentation for what they have disclosed in their application. I'll give them a pre-qualification letter because I've run them through an automated underwriting engine that we have that tells me that this is a workable loan, this is a doable loan. It has not been in front of a formal human underwriter. And typically, the pre-approvals, in my opinion, have been to a formal underwriter.
Okay.
So where all they have to do literally is get an appraisal
Right.
and close the loan.
Yeah, because realtors, selling agents ask for the
Right.
right of way, so
Right.
we need to have that.
Yes.
So I work a lot with first-time home buyers and with people like teachers and people
Right.
that may not have the highest of incomes. Are there any good programs for low down payment or first-time home buyer
Yes.
programs?
Yes. We've got several down payment assistance programs, and there is one that is specifically geared towards teachers, firefighters, police officers, EMS. And it can go all the way up to 5% as a grant, 5% of your loan amount as a grant that will take care of your down payment and some of your closing costs.
Okay, yeah, down payment assistance programs. That was
Right.
you're just
Yes.
reading my mind. That was the next question. So there are
Yes.
programs
Yes.
available for down payment
Yes.
assistance.
Yes.
Okay. And then do lenders ever go and see the home that the first-time home buyers are requesting a loan?
No.
They
No.
just send an appraiser out?
The appraiser goes out, and it's from a third-party appraisal company, and we don't have any idea who the appraiser is. We don't know when he's going out. We give them the contract, and we give them a projected date that we need the appraisal back, and it just miraculously shows up, hopefully on the day that it's projected due.
Now,
So-
when do you order the appraisal?
I don't order mine until after you've gone through the option period and you know that you're going to proceed on the purchase. Because if there are repairs to be done, you don't want to jump the gun and order it whenever you're still negotiating on whether or not the roof gets fixed or
Oh, absolutely.
the slab gets fixed or whatever. So I wait until after that's been done, that's negotiated, what's going to happen with those repairs. Then I order it because that amendment must go with the contract to the appraiser.
Now, what happens if the appraisal comes in lower than the asking price of the house?
Oh my, it's bad.
It's bad.
It's not a very good situation. There's a few things that have to happen. Let's just say for easy math, it's $2,000 low. The seller has to come down $2,000. The seller has to give $1,000. The buyer has to give another $1,000 out of his pocket on top of his already down payment and closing costs, or everybody goes home. It could literally bust the deal.
And do most houses appraise for what the asking cost is, the selling price or listing price is?
In my experience in Austin for the last 26 years, I've had a few that did not. I don't believe this is the middle of August. I don't believe that I've had one come in this year that did not. And it was a small condo on the east side. So
Okay. Well, let's kind of change directions here and talk about the actual home buyer. I'm working a lot with people, some divorced or separated or things like that. And so when you're looking at Texas being a community property state, can one spouse borrow for a home, and does the deed have to be put in both people's names if they're separated and not divorced?
not an attorney, but from the mortgage side, if you are separated, in the mortgage world, you're still married, period. And the spouse, the non-purchasing spouse, would have to sign a few documents, one of those being the deed of trust at closing. And typically, after that, if that happens, they'll go to their attorney and do what I believe is called a quitclaim deed, which relinquishes their rights and interest to the property. But the actual answer to the question is yes, that person can purchase. On a government loan, if the spouse is not purchasing, you still have to pull the credit report. The credit report goes in the file, and we have to use that person's debts along with the other debts in the qualifying debt to income ratio. So if spouse has a car payment, a $600 car payment, it has to be added to. On a conventional loan, it does not.
Oh, interesting to know. Well, you know what? I think I'm out of questions.
Oh, my.
Thank you so much.
This is awesome.
To you.
Dear,
No, thanks for answering all my questions. I appreciate it.
Thank you.